it started about 2 years back and has been doing exceedingly well. We have been very fortunate to get the best policy-making minds across the world to come and speak to us. We have had the privilege of two Nobel laureates. We have had about 50-50 Indian speakers as 50% foreign speakers. And we have touched almost all contemporary issues that were burning at this point of time. We have discussed economic issues, health issues, agriculture, other socioeconomic indicators. We have also discussed geopolitics. It is in that context, and continuing with that discussion about contemporary issues, we came across an excellent book, The Macroeconomic Policy in India Since the Global Financial Crisis, especially the post-COVID by Springer, by Professor Sebastian, and we requested him, and he has accepted our offer. To chair the session today, our invitation was accepted by even Dr. Virmani to chair the session today. And so we are going to have an excellent interaction from the professor. And Dr. Virmani himself is an authority and has been at the helm of affairs right from the beginning. He's been in the World Bank, he's been in the Planning Commission, he was the chief economic advisor of our country. And then 2009 to 2012, which was the crucial period immediately after the global financial crisis, he was the executive director at the International Monetary Fund in Washington, D.C. He has himself played a very prominent role in policymaking in our country. He has articles in refereed journals, and he has books to his credit. With this, I'll request Dr. Virmani to take over the session and conduct the proceedings.
Thank you, Charan. I'll start on a personal note before I go on to the formal introduction. When Charan mentioned about a week or 10 days ago that Professor Sebastian Morris was going to speak, my memory went back 25 or 30 years ago, when I used to have interact with the macroeconomists, and there were very few one could find. And I still remember Professor Sebastian Morris's name as one of the maybe 4 or 5 handful of macroeconomists in India that I could identify and sought to involve in from the government in macro activities. The second one, of course, is that I was CA from 2006 to 2009 when the global financial crisis occurred and dealt with it. So in that sense, Professor Sebastian should be prepared for questions because I did deal with that crisis and have a pretty deep knowledge of it. And of course, as Charan mentioned, that after that, I got also a global perspective. We were very much involved in all the discussions about the crisis in different parts of the world. But anyway, that is just an aside. So let me introduce Professor Morris. He is Senior Professor and Chair of the Center for Public Policy and Governance at the Goa Institute of Management. He has been dealt with many issues of macroeconomics in infrastructure, Indian economic performance, public policy at the Indian Institute of Management, where he was for 25 years before that. He has also been the ICCR Chair Professor at the Copenhagen Business School and Ford Foundation Fellow at the University of Pennsylvania. He edited and had a big role in the India Infrastructure Report, various aspects of it. And he has been lead author of The Growth and Transformation of Small Firms, a book on growth and transformation. He has acted as a consultant for various governments and originally designed programs for several senior civil servants. So he has a wide knowledge of theory, empirical, and public policy issues. With that, let me hand it over to Professor Morris. And as we just discussed, perhaps you can speak for 40-45 minutes so that we'll have 15 minutes at least for further discussion.
Yeah. Thanks, Dr. Charan Singh, Dr. Virmani, and all the others in the in the panel.
Sebastian, Morris.
కలిసి
Hmm.
అట్లా ఒక 1 day
ఎక్కడికైనా వెళ్తారా? చూడండి దగ్గరలో ఉన్నాయో.
Yeah, so I was saying thanks to Dr.
Happy
Charan
one.
Singh and Dr. Virmani. And can I just use a share a screen?
Yeah.
Okay, I'll try sharing the screen. Yeah, and okay. So I'm going to share the screen and yes. So, let me go straight to the key findings. Okay. And I'll emphasize the findings that are relatively controversial. Okay. Yeah. So there's a lot of been discussion on the growth since the global financial crisis. And one explanation is that there was a policy paralysis around 2011-12, and that kind of brought about the decline. And then since then, the growth has not been particularly high, especially when you compare it with the period in the run-up to the global financial crisis, where we achieved 8.5% growth. And in the immediate recovery, when we hit 9%, thanks to the government counteraction, which had happened then, with that massive fiscal stimulus and so on. Some would have claimed that that fiscal stimulus was kind of overdone and hence we hit 9 instead of holding the growth at 8.5. But anyway, the point is the RBI began to pull back because it saw high inflation. So more than the I would say the policy paralysis per se. Policy paralysis was certainly important. What is neglected is that the central banks highly restrictive policies came in around 11, 12 and 12, 13. Okay. And this happened because they saw very high inflation. I've shown that this high inflation was only a will of the wisp. At least 3 to 4 percentage points of it was fictional. But they were addressing that. And hence the at the time when the stimulus was being pulled back, which it had to be, I guess, and anybody would agree it had to be. And at the same time, the central bank pulling the demand, the growth came down and rather dramatically from around 8.5% to a low 5, actually less than 5. And then it kind of picked up and it maintained something like an average of 5.5% till 2019. So the best evidence of this is really the low GCF that we achieved after the 2000 and after the global financial crisis and the up to the global financial crisis, and then after that for the 2 years. So since 11-12 we have had a low GCF rate under 5.5% growth, and it came down to about 4.5 towards the very end of the period, that is 2019. In between we have had growth which was much higher, 6%, 7%, in a couple of quarters even 8. The official data here is problematic. And if we account for multiple sources, which is what the book spends a great deal on, look at, let's say, hard indicators, soft indicators, and kind of weaves them all together, then the growth since, let us say, 2012-13 was pretty low. And when I say low, it was certainly not a recession or something. It was around 5.5% average. Okay. Now, the employment was practically stagnant from 2016. There was no growth in employment from 2016, largely, and this is based on the CMI data, which by now everybody would recognize as being reliable. So as I said, the RBI's tightening was important, but the RBI continued to maintain a tough stance right through. In fact, there was no response to the taper tantrum, and as a result, interest rates went up to record high. The the so-called low bond yields which happened from 2018, when the RBI started loosening, that's the only period when there was a loosening. So the point is that through much of this period, the low-end bond yields, okay, that means the 3-month, 1-month kind of bond yields, particularly the 3-month, 4-month, were well above the repo rates. So that the repo was not really acting as a window to was no longer actually the policy rate, but it was it was kind of below the policy rate. So it was below the effective rate. So the repo could not be claimed to be the policy rate. And this has been a phenomena that has been there right through the period from 11-12 onwards, almost till 2019. in a stop and start. Not in every year, but in the majority of the years, this was the case. And this implied a kind of credit rationing. And from 2014 onwards, when the RBI picked up, inflation targeting, and especially after the Urjit Patel committee report, which was in 2013, when de facto the RBI had picked up inflation targeting, what has happened is that the inflation targeting may have contributed immensely to the financial market uncertainty. See, the argument goes something like this, that the inflation targeting in India is based on the CPI rather than the core part of the CPI. Okay, and that creates a big headache because the volatile food and fuel prices are simply supply side driven, and there is no way a demand cut can bring about a reduction in demand for food because the elasticity of food is very low, and you're talking about drawing people's incomes to very, very low levels if it has to be in fact. But the demand side measures will hurt other production and so on and so forth. So food, when inflation is food based, the demand or aggregate demand side measures are bound to be extremely expensive, and that is what we have seen in the economy. Okay. Uh, Similarly, fuel is not under its control, so there is no way the RBI could have, should have taken up that. However, the Rangarajan committee or the Rangarajan's report suggested the use of CPI because the share of core is very small and the share of food is quite high, around 45% those days. And they said that, look, if you are inflation targeting, if you target only the core, how does it help the poor? Because they are all dependent on the food. Now, that's not a very correct argument. You can target only what you can control. And certainly the RBI is in no position to control the supply side of food. It could consider the demand side of fuel a little bit and so on. The only way it can do it is by slowing down growth quite a bit, by hitting hard gross capital formation and new employment and so on. Okay. So the point is that that contributed also to market uncertainty. Now that's generally missed because when you target the core, when you target CPI, since much of it is commodity, and commodity can be volatile. Okay, the future behavior of the central bank in terms of the desired interest rates or the target interest rates is going to be also very uncertain, and therefore even if the low end yields come down, okay, the high end yields are not going to follow, and hence there is going to be a huge transmission problem. Okay, so the first level transmission problem is really in the choice in that case, is really in what the RBI does. At the second stage, only the banks come in. The second stage transmission problem is well known, which I won't discuss. Okay, so since 2019, though, there has been a reversal by the RBI as less academically doctrinaire central banker came in who was kind of more responsive to the situation. And perhaps the COVID, rather the response of the central bank to the COVID, which was to increase the liquidity in a very major way and reduce rates and so on, was very instrumental in finally overcoming the crisis in the financial sector, which had been building up and which had not been addressed correctly. Okay. Now, on the fiscal side, what were the factors which led to the low growth or which may have contributed? I would think the monetary side has been more important, but let us say on the fiscal side, under decline in MNREGS, that means the government, the BJP government was, of course, kind of in its core DNA was not very appreciative of the MNREGS, which is fine because I'm sure they had other more better targeted, with lower leakages programs in mind. However, when the MNREGS declined, there was no compensation in terms of rising other government expenditures or private investment or any such thing. Okay, perhaps the underspending of the government, the first budget and the second budget, there was a 7.5% underspending by the government over what was budgeted. What was budgeted was also very much in line with bringing down the fiscal deficit, and that underspending may have contributed quite a lot. Now, when we worry about why this underspending happened, from what I could understand, and remember my access is limited, so based on whatever I could talk to senior civil servants, what they tell us is that the extreme centralization within the PMO may have contributed to this, because even line departments or other expenditure, various departments of the government may not have felt very comfortable going ahead and spending despite having approvals, for the reason that they wanted the conscious that the PMO had to be consciously aware of it. Okay. Now, there was also a continuing tax terrorism which people talk about, namely that the targets for taxation, particularly direct taxes, continued unabated. In a world where the inflation had come down now and the growth rate had fallen very significantly. So given the high tax rates at the high tax growth rates which were demanded, the exercise of kind of arbitrary measures to shore up the collections just before March 31st of every year was a continuing phenomenon. It had been there even before, but now it became a continuing phenomenon, and also perhaps became a little bit more onerous because the nominal GDP growth was small in this period, particularly after 2016. Okay. Now, GST was a great thing. Everybody would agree that it could not have happened without the initiative of the Prime Minister, for the simple reason that he could have taken a call on Gujarat and the center simultaneously, and because, as we all know, GST was quite against the interests of production-oriented states and highly in favor of high consumption states, and therefore, Tamil Nadu, Gujarat, Chhattisgarh stood to lose. And what actually happened was that, since Mr. Modi was there now, the minister, the prime minister, he could actually take this decision without any kind of reaction from Gujarat. And that meant that a wonderful thing like GST happened, which would not have otherwise happened, because it's great for the long-term integrated development of the country, market integration, scale, and all that, which we all know. However, the GST being good actually increased the effective tax rate because the compliance went up. Now, when you have an increasing effective tax rate, there is a need to worry about the expenditure effects of that, okay, on the economy, and government should have compensated for that in some way by either reducing the tax rates or increasing the expenditures elsewhere. So there was also a kind of what one would sense an unconditional pursuit of fiscal deficit targets, irrespective of whether the economy was on the downswing or on the upswing. So that kind of sensitivity was perhaps not there, because and I've tried to figure out why this is so, because perhaps there was an overriding accountant's framework and not an economist framework which was driving, and so on. So I don't know. I mean, others could say more about this. Perhaps most other spending, many programs were announced, but while they had some impact in terms of increased spending, because when you consider it from the demand side, spending is what immediately has an impact. They had little strategic base construction. What I mean by that is that, let's take, say, smart cities, Swachh Bharat, and so on. They did not have the creative, constructive, strategic, design which had happened under Vajpayee, when we had the NHDP, PMGSY schemes, which were really wonderful schemes, and which led to massive increases in government spending, and very functional even from a supply side efficiency point of view. And the immediate demand side effect of the massive spending on the golden quadrilateral in 2002-3, 2001-2, and so on added up to give us that huge bump up in growth from around 5.5% to about 8.5% from 2003-4 onwards, which was maintained and even accelerated over the period till the global financial crisis. Okay, and also brought crowded and massive private investment. Okay, so there was no such thing, although the potential was there. And here probably the details of the working of the government at the bureaucratic level may have to be considered. Remember, the NHDP, PMGSY were created not entirely by the line departments, but by the planning commission with other specific, talent which was there at that time, along with the IDFC, which contributed quite a bit to the design. Okay, so government spending is important. 2019, the government spending improved, particularly again on that PMGSY on the roads and so on, which is actually quite important, and it's a key story in explaining the variation and in at least maintaining the growth up to about 5.5% average. Because remember, private investment had all but collapsed over the period. Okay, and yeah. Now the COVID and the recovery. Okay, now here the point that I would make is that the COVID impact was somewhat larger than it needed to be. Okay. Now, the reasons are, of course, the nature of the lockdown, which I've argued was more territorial and dysfunctional rather than functional. For instance, administrative boundaries were made rigid. A large city like Delhi, which is a urban agglomeration, people had even key resource persons, key service persons like doctors had problems crossing from, let's say, Noida to Delhi, Delhi to Ghaziabad, and to Haryana and to Gurgaon and so on, which which is just illustrative, but essentially the seriousness of the completeness of the lockdown, which hurt all kinds of production, and the suddenness of it created vast problems. But the good point is that agriculture was not affected because the produce was lifted and stored. So the inflationary impact of COVID, supply side disasters, was completely avoided by India, and this really stood us in good time in the future. Okay. Yeah, when you look at it, about 15%, about 12 to 15%, impending shock was what one would consider as the COVID, 12 to 15%. Maybe around 12% would be more correct. So I'd worked with numbers of 8, 9%, 12%, and so on. Okay. And a simple simulation model helps us to make an assessment of the impact and the impact of the counteracting measures that the government put in place. Okay. So the government came out with a 20 lakh crore overall package. But if we look at it and break it up into fiscal, both direct and transfer part, the credit liquid, then that part is much less. Okay? That adds up only to about 1.68% of GDP rather than about 10% of GDP, which is claimed. So the rest of it is credit, liquidity, and limit enhancement, particularly states borrowing enhancements and so on. Now, if you add up all that, obviously it adds up to 10%, but you can't add apples to oranges to engines and so on. So that was, of course, everybody did that in the policy space and so on. That was well understood. But when you look at it very closely, but the actual fiscal measures and the transfer measures, one had to painstakingly build this, and that actually took a fair amount of time. Okay. So if you work with a 1.68%, of which about 1.8, 1.8 or 1.2 was direct fiscal, and the remaining that was transfer, then we had an impact of around 2.5% on the growth. Okay, so the net impact would have resulted in minus 9.5 was my initial assessment. Actual turned out to be minus 8.5. So there was possibly a underestimation in terms of the consumption decline that would take place, and that corresponds because what happened is that many people actually dug into their savings, gold, and so on, and spent on that. Okay. Now the recovery till September 22, if I were to note, okay, we have recovered on a level basis. That means we have reached the same level as before the COVID and maybe gone a little ahead of that now, but not yet on the trend. That means had we continued on a trend growth of what I would believe is, let's say 6% at the minimum, we are still not on that. That means we have not recovered the lost growth over the 2 years of the COVID. Okay. Most notably in manufacturing, we are not even level. Okay. The backlog in employment is actually huge. Okay. The unemployment figures are not very meaningful. Okay. And the reason is that when the unemployment, obviously during the COVID, the unemployment went up to 28% levels, but then they quickly collapsed as well. And they collapsed largely because of the fall in the labor participation. Women's participation had fallen to as low as 6%, okay, during the COVID. And when the recovery took place, the unemployment recovered with a big part of it being a recovery in agriculture. We know agriculture is a kind of residual sector with a lot of disguised unemployment. So if you look at the fruitfully employed people, then there is a vast amount of unemployment of people who lost their jobs, who have still to get their jobs. And this is largely in manufacturing, around 3 million manufacturing and closely associated services. But the data is not very great. This is entirely from the CMI surveys, which, as I said, I do believe is very good, and people are beginning to realize that. The apparent contradiction with the stock market is not really so when one looks at it. Not surprising, since the fall in interest rates, including the medium and long period rates, would have given a big boost to the valuations. Okay, so my model tells me that the entire rise in the stock market till the inflation pickup happened, till let us say October, September of 2021, can be easily explained. Okay, and by the increase in the valuation which happens when the discount rates fall, by the lower corporate tax which had happened on the eve of the crisis, and today I would think that the stock market, which should have fallen, is being kept up by the China Plus, China Green, and China COVID, and the PLI. Okay, and all acting together. So today the manufacturing outlook is somewhat better. Okay, and yeah, so this is what the COVID and the recovery would lead us to. But I'd like to quickly go on to the issues. I think both the experience of the COVID, the experience of the GFC, both in emerging economies like ours, as well as in the advanced countries, all point to the need for fiscal and monetary policy coordination. Okay, even if monetary authorities need to be independent, uh, the need for fiscal and monetary policy coordination is very high. So I'm not saying that this necessarily leads to denial of independence to the central banks, but what it means is that the central bankers have to be acutely aware of the need for fiscal and monetary policy coordination. Okay, and in India and for an emerging economy, this is more logical than it doesn't have to be empirically shown. In an economy with vast disguised unemployment, disguised employment, disguised unemployment, that means with vast idle labor, Lewis, but operating in a global environment, the production function is only one factor if you ignore land. In other words, if you add capital, private capital especially, which does not have a demand side, no private firm is going to add capital unless there is a demand side. So if there is accumulation, then there is no, and if there is no constraint on labor, which is the case, then the YF, or the full employment or the full capacity output, can actually rise. So in other words, the full capacity output is largely endogenous rather than being driven by technology shocks, as is the case with the advanced country macroeconomics. Okay, so there is a need to track both the capacity output as well as the demand determined level of output, which is all macroeconomic models do simultaneously. And this, I think, Indian policymakers have been among the best to do, as exemplified by the response to by the design of the very structural adjustment, stabilization and continuing thing, and the continuing macroeconomic policy management, because reforms have always been dovetailed into macroeconomic policy. Okay, that may have weakened in recent times. Okay, and perhaps strengthened after the COVID as well. Okay, so the point here is that reforms cannot be realized, that means structural reforms, unless there is synchronicity with macroeconomic policy. One example which I've already mentioned is, let's say, GST. Yes, GST is great, but it would have required a macroeconomic synchronicity. Similarly, many other policies which are potentially there have not worked out because the macroeconomic side may have not been conducive to their working out, and vice versa. That means that some of the macroeconomic policies may not have been realized if the structural change or deeper reforms or second order reforms have not been the case. So we have examples of that right through the experience since the liberalization of the Indian economy, and I have documented all of that. Okay. So now this is why. Why is this so? Because of the emergence of idle labor makes growth rates achievable. The growth rates that we can achieve, any emerging economy, endogenous rather than merely out of technology shocks. So in that context, therefore, the external shocks are not really an excuse for highly varying growth. Okay, because there could have been the right kind of response to these. Okay? The second point, which is more for the central bankers really, is that there is a need to move out of inflation targeting. I think even Bernanke's claims on inflation targeting before the global financial crisis, which he claimed through a book brought out by among the leading, macroeconomists at that time, uh, made a claim that look, inflation targeting had worked wonderfully over in Europe and then in the United States to bring inflation down to very low rates from the high rates in the mid 80s. And it was inflation targeting and its adoption, uh, increasing adoption all over the world, including in, and somewhat, all over the world, which was responsible for it. And they do case studies of so many economies which went through inflation targeting or which did not, and which then adopted inflation targeting and showed that this was the case. Now, there is a lot of meat out there to chew. But what I'm tentatively putting forward is the following. Okay? This was also the period over which China zoomed ahead and South Korea still continued to fire on its cylinders. Okay, particularly till 2000. This was also the period in which Taiwan and the East Asian bloc, okay, were pursuing export-led growth. So when they were pursuing export-led growth, concomitantly what it meant to the recipient countries is that they were getting these imports now from their point of view cheaper and cheaper and further cheaper. That means they had a very positive terms of trade impact, a positive supply side effect with, if you want to call it that, the aggregate supply curve on a p hat on an inflation y space actually going down. Quite exactly the reverse of what happens when you have a stagflation or when you have a imported inflation, which is the case today. Okay, and that would have given a tremendous, low inflation with high growth to the US economy, European economies, which kind of were relatively more liberal and so on, and which allowed, better in migration and so on. And the claim that it was inflation targeting in the sense of demand side measures that were being used to control inflation may have been overstated. Okay. Now, this is not to say that if demand goes out of hand, there won't be demand side inflation. Okay. So the demand side inflation is a well-known story and well recognized. Okay. However, what needs to be understood particularly from the emerging economies point of view is the role of supply side inflation. And here I've drawn a contrast with China on the one hand and India on the other, and pointed out that China has always handled its inflation by asking the question whether it's demand side or supply side. And if it was supply side, they have been very tolerant of that inflation. They have attacked only the first order effects and not the second order. And therefore, Chinese growth was never affected despite the high inflation. Okay? So there have been periods when the overall inflation, at least measurably so, was about 18%, with food inflation running into the low 20s and so on. And yet they did not hit the demand the way we are hardwired to hit. The moment we see a higher inflation, the RBI just jacks up the interest rates, and that's almost like a gospel. Okay, so that needs re-examination, this inflation targeting, and particularly that the context here in India, because given idle labor, okay, and given the fact that much of the inflation driver is arising on account of food, and we do have surplus food, and we do have efficient methods of rationing, unlike the advanced countries, food inflation should not be hurtful. Okay, if rationing can if the ration prices can be held. Okay, and if that can be done, then there is no need to kill the demand generally. Okay, and work through this blunt and very indirect and low elasticity instrument. Okay, so that is something which I'll emphasize. Then I think the whole agenda of manufacturing in India has still not been addressed. Okay, the PLI, which is more of a micro, thinking scheme, is beginning to work in a certain limited way. And let's understand why it is beginning to work. Remember, the PLI was actually there with the DIPP's throughput support scheme way back in 2015. Okay, when Dr. Kant had just taken charge and he was very keen on this and so on. Now, the reason for the PLI is it's only second best. We all know that. The reason is that the bound tariffs for India on items like, let us say, laptops, iPads, mobile phones, flat screen TVs, and solar panels have been very low, have been nearly zero. Because when we joined the WTO, we bound the tariffs on push button telephones and picture tube TVs and so on high, hoping that we could capitalize on manufacture of that. And these anyway, the imports were so low, the use was so low, we thought, okay, let's give in on a zero tariff there and get into the WTO. Once that happened, the growth actually took place on the zero tariff items because they were the modern items. And today, India has emerged as one of the largest importers of electronic goods. In fact, out of close to 100, maybe about 90 billion electronic consumption in India, use in India, about 80% was being imported till recently. So now to counter this, either you'll have to go back and renegotiate or give incentives, because many of the other policies were kind of orthogonal to manufacture in India, including very high prices of non-tradables, okay, water, electricity, transport services, and so on. And these are actually the major targets for second generation reforms now. If our regulation continues the way that it does in the electricity sector, we are going to continue to hit competitiveness of India. Okay. The debilities on electronics, the ESA had calculated, which I've quoted and used extensively, was of the order of 7% in some sectors to as high as 35%. Okay. And there was no sector with a zero debility or anything less than 7.5. And even in the 80s, the tariffs were inverted in quite a number of areas. And that again, the evidence is there, although kind of getting lost under the general doctrinaire discussions that take place in India. Okay. So the point is, there are a whole lot of policies which are discriminating against exports or against manufacturing in India. Some sectors have it better, for instance, the auto. Okay. And the auto sector has it better because of the policy which was designed and put in place by a very foresighted person called D.V. Kapoor, who was then the secretary in the Department of Heavy Industries. And what he did is he created a policy of heavy tariffs on fully assembled cars and very low or relatively very low tariffs on components which could be used. So that set the motion going. And then, of course, many components also began to get manufactured. And then other policies, which drove the sweet point and gave converged the markets to a sweet point and gave scale economies to Indian production. Okay, so yeah, so now these are important factors. However, the macro policies have always been kind of orthogonal or not exactly desirable from the point of view of manufacturing, because the interest, sorry, yeah, because the interest rates have been significantly higher than in our competing countries. So when I say higher, the counter would be that, look, also inflation has been higher, so what the hell are you talking about? No. Now the point is, that's one way of looking at it. There is another way, which is the looking at the uncovered interest parity. So if you look at the uncovered interest parity, it's well known that the uncovered interest parity does not hold in emerging economies, and certainly not, I mean, may not hold in non-reserve currency countries, and certainly not in emerging economy countries, this context. Okay. However, the degree of violation is very important. Okay. The Chinese degree of violation is relatively very low compared to India, almost a 2% difference with the India. So what it means is that Indian firms have a handicap of around 2% in the valuation that they can attribute to businesses in India. So it kind of creates a negative bias against investment in India, even though the management is quite capable, and it leads to a larger outflow of entrepreneurship from India. So, and of course, it leads to an underpitching of the private investment rate in India. Okay? So this is extremely important because the Fisher Open or the uncovered parity condition is the Fisher Open is the excess over the uncovered parity condition, and that is that the interest rate difference minus the actual exposed realized depreciation of the currency, and that has always been large and positive for India. Okay? We need to bring that down. Okay? So this would mean again more aggressive macroeconomic policy, more growth oriented macroeconomic, and not an interest rate which is determined entirely by the needs of inflation targeting or the desire to hold the flow of capital, flow of portfolio capital into the Indian economy high, which you can't actually unless the current account side is different. So what it also means is that the central banker should treat the current account deficit and the capital account deficit in very different ways. And this is a universal conclusion that has emerged from a look on the crisis in many countries. Okay, so the point is that manufacturing needs a big correction. Okay? And in that context, the PLI comes in, but the PLI, as I said, was not effective till now. And why is it somewhat effective now? Because the China plus factor is really significant. Okay? With China going madly aggressive on everyone, the world doesn't believe that having a plant in Taiwan would insulate it from the risk of force extension by China. So therefore, Taiwan is no longer a second an option which is different from China anymore for global investors, global manufacturers, okay, global supply chains. And therefore, there's a willingness to consider India, despite its obviously very inferior governance and particularly local governance and such other factors, okay, and macroeconomic factors. So the second is, of course, China itself going green in a big way and willing to hit hard. It's even, so this is a Z kind of phenomena. And then, of course, China going COVID. The zero tolerance COVID. So all of this has come together to give, I would think, a significant, boost to manufacturing in India. But it's not yet reflected in higher employment as that has taken place. So I would kind of stop here and hope that there are comments and critique and so on. Okay. So thank you.
Thank you for finishing in 45 minutes. Given that we have a brief time, let me just say a few things. Firstly, let me actually start by, giving, in EGROW, Charan, you might want to note that we have a number of papers which are relevant to, I'll just mention a couple of them, both to the pre-2014 period and the post. The two which are relevant for the pre-period is, we have a paper called Investment, Corporate, Industry and Households. So this looked at what has happened to investment, and what it basically found is that the decline in the share of investment, which has many people keep referring to and blaming or talking about as affecting the growth rate since the peak of the growth past somewhere in the 2012, 13, thereabouts, is really 90%, more than 90% is due to household investment. So you have to look to either the interest rate pattern, which we do, and to other factors like black money, etc., to explain this. The second paper, which is there on our website, is titled Demonetization, Deceleration, Demonetization, and GST, where we looked at the effect of demonetization and GST on growth. Now, besides this, I think my thesis since managing the economy in 2008-9 has been that post when I left, unfortunately, I have to time it by that because when I left, I had warned and told everybody that if we return to the growth path that we were likely to do in 2010, the fiscal and monetary stimulus, which was absolutely critical for saving the economy from the financial crisis, must be withdrawn. That did not happen, particularly in fiscal. And just for people to remind very briefly, there was a big boom from telecom auctions. So despite this once in a one-time gain on the revenue side, much of this revenue gain was just spent, even though it was not necessary. The economy was back on the old growth path by 2010. And therefore, basically, my conclusion is much of the ills that came after that were due to excess fiscal stimulus. The second aspect was related to that. One is that the investment in infrastructure, which was being pushed before the actions to take care of NPAs arising from this infrastructure lending by the public sector banks, etc., was not taken. And related to that was the effect of the, because there was a boom before the crisis, so many private sector companies and of course the infrastructure, the government had projected on the basis of a very high international and domestic growth rate. So once the GFC crisis came, these expectations should have been adjusted, and the credit for creating more capacity for expectations about infrastructure lending going bad, etc., those expectations were not revised. So the monetary and credit policy went on as if that old boom would come back, that this was a purely temporary thing, not just for the level, but for the rate of growth. So these two fundamental mistakes, in my view, led to that mini BOP crisis of 2013-14. Why do I say this accommodation? Because even the chief economic advisor who succeeded me, I won't name him because I'm going to criticize him, he not only urged even more monetary stimulus, lower interest rate, but even developed a theoretical framework for pushing that idea. Okay, let me leave it at that. So that is the part before 2013 sometime. On the subsequent period, again, we have two papers which are very relevant, EGROW papers. One is called the J-curve of institutional reform, where we link, we review all the actions, including inflation targeting, the effect of GST, etc., IBC, and many other factors in this paper. And the second one, the first one is in 2020, early 2020, and then another paper called Lockdown Economics, the Fiscal Policy During Pandemic in May 2020. So these two papers are very relevant for evaluating both the policies and the impact. Of course, they don't, these two papers don't go into, well, the first one does, of course, J-curve, but the second one is more forward-looking in the sense of what is the conceptual basis of fiscal and monetary policy. Now, to summarize from all this learning, the two things in post which are basically associated with Raghuram Rajan and his successor, this is where we agree. I agree with Professor on his conclusions on inflation targeting. I think there were what these papers, the first paper, the third paper in a sense, but the first after 2014, shows is that there was an obsession with inflation targeting which went overstep or over tightened the monetary policy. So that is shown in these papers. So that over tightening of monetary policy was the most important factor. There were, of course, a whole bunch of other things which are also discussed in that. The areas where the second paper also talked about the need for targeting of monetary and credit policy, targeting of fiscal policy, and monetary fiscal coordination. So again, on monetary fiscal coordination, Professor and I are completely on the same page. In that context, I should mention that from my time as a macroeconomist and a CA, I have always emphasized this mental model of flex, in managing. I never had the luxury of working in a university and theorizing, but I think professors theorizing is very close to mine. In my mental model, I always had a supply-demand framework where the supply curve was a kind of curve and a demand curve shifted. So I didn't have the classic ideological monetary view of the world where you have a full employment economy with a flat, straight up and down curve. I always had a flat portion and a curve. And for me, managing the Indian economy was always an issue of finding out where we were on this curve at any given time and at any given shock. So I think the model which Professor is proposing is similar. It may not be exactly the same. So again, I think we are on the same page on that. Importance of structural reform, absolutely. This is something, after September 29, the structural reform, I had kind of given up by the budget of 2019 that there would be any good structural reforms, and was very surprised by the September 2019 structural reform. So I actually took the initiative. I had said, there's no point me advising the government on anything. They are just not going to do reforms. But after the September 2019 reform, I contacted the government, and they understood and invited me in early 2020, where I plugged for structural reform and emphasized after the epidemic how important it was. And clearly it was heard. So on structural reform, again, the importance of structural reform, I think I broadly agree. But the gap actually started in 2009. As again, in 2 interviews, I said that the reforms must continue. They were stopped. I wrote this in an OECD book with another author, Malhotra, on this. But there was a gap. The government was coasting on the reforms previously and did very little structural reforms to promote and sustain growth from roughly 2004 to 2012 or 2013. So that is my view, which is not exactly similar to professors, but I think there is some overlap. We've already talked about inflation targeting. I think your whole points on manufacturing, PLI, tariff reforms, I didn't quite fully get, but just let me state, and again, there may not be a big disagreement on that factor, but I was deeply involved in the 1990s tariff reforms, and our approach was twofold. One was to move towards uniformity. And I tried to explain this very simply. So we are similar in this, that you mentioned the IT0, IT1, which had a tremendously bad effect. I was the only person in government who opposed that agreement, actually. Nobody else understood. At the time it happened, this is even before the reforms really got going, was that every output is an input into something else. So the effective tariff is what matters, not the nominal tariff on the output. I found this very hard to explain to people. And by the way, again, without mentioning, it was hard for economists to understand. This is the crazy thing. Very prominent. Again, I cannot name them, but if I name them, you would instantly know the name of the economists I'm talking about. It was hard to explain. That is the effective tariff, not the final tariff which matters. Okay, so and what I tried to convince them was that the only way to assure 100% non-inversion of tariffs was through a uniform tariff. We may still choose not to have a uniform tariff, but if you do 1 or 2 here and there, it won't make that much of a difference. But the objective must be uniform. And in my 2001 report, the last one I did in the government as chair of that committee, I gave a schedule, for political reasons, we always had to adapt and adjust these changes. You couldn't say, just go out one day and say 100% of goods will have, let's say, 10% tariff, okay? But as long as the objective was clear, you could gradually phase in some of the tricky ones. For example, automobile tariffs were quite tricky because there was such a vested interest in the final good, which you, Professor, mentioned, that 60%. But we were very aware of this. I gave a schedule of reduction in 2001 for this, which never happened, of course, as you know. And agricultural tariffs, which are very sensitive and still are, but we still need to think and rethink about them. So I think by and large, if I've understood you right, we are more or less on the same page on this whole PLI tariff thing. So with that, let me at least I've taken a bit of time, but let me hand it over Charan. Yeah, Charan has read your book, so maybe he has some questions. And I see another hand, but not clearly here. But Charan, why don't you go ahead?
Yeah.
And maybe we can
Professor,
go 5 or 10 minutes over the time we had set.
sure. Professor, I must say it's an excellent book that you've written, very analytical and very easy to read. So that is the beauty of the book. And I wish many more people are able to read it and take the benefit of it. You have explained in your presentation so well. And then after that, Dr. Virmani, I think, has supplemented your research exceedingly well. So the complete canvas is so clear. It seems there's a convergence that is happening on the way ahead. And also in terms of the gaps that are there. As you know, the story of the dip of growth that took place from 2013 onwards and continued, and various explanations have been given. Your own explanations are very good. And I like the way you mentioned it, the tiger period. So that's the period when it is the growth is doing so well. And then, of course, there's a dip and then it continues. And of course, the two major reasons, of course, is the GST and the way it was designed or implemented. And then, of course, demonetization, which comes out very clearly in your book. Really thankful to you for writing such a lucid book. So my questions are going to be very simple. I totally agree with both of you. Inflation targeting, and I've been writing extensively, is not meant for a country like it. And I think after 2008, it was so apparent. Just imagine Jeffrey Frankel writing from Kennedy School, inflation targeting is dead. And then Urjit Patel chooses to mention it. And then the governor at that time chooses to implement. And then, of course, it's modification that happened there. I don't think it carries any conviction that in a country like ours, inflation targeting. And just imagine Blanchard at the IMF in 2009 and 10 is saying that inflation targeting needs to be carefully looked into, and our country then implements it. So you are right, there is something, and that could be deterring growth. So you're very right on that. Even now, my worry is, and that comes out in your book, the way the Reserve Bank reacts and conducts its monetary policy, they are hard bound because inflation targeting regime is there. But is it possible that one can give it a pause and say, okay, let's first grow and then we will see? Also, the point I would like to make is all this hue and cry that's being made in the market that inflation is very high in our country, we are on the upper band. When we compare it with the rest of the world, especially America, UK, Euro, they are 4 to 5 times more than the tolerance limit, the normal long-term trend. So this inflation targeting, in a way, is so blinkered and distorts the policy priorities. And therefore, in your book, the way you handle it is superb in giving it the negative connotation that it deserves. Now, my first question then is, if not inflation targeting, at the end of the day, we need to anchor expectations. As you know, the world of monetary economics has moved on from the times when we were scholars and students. Now expectations play a far more role, and they are forward looking vis-a-vis the inflation that we used to think is backward looking. So therefore, what would be the right anchor according to you to talk about anchoring inflationary expectations. As you know, Jeffrey Franker says nominal GDP is a good anchor, but I just wanted to know your thoughts on it. The second question I have is regarding the food, the way the second question I have is on food. Now, on page 116 of your book, you mention about wrong weights for food. I totally agree with you. I was at the RBI at that time, and we used to really discuss that in the new CPI, the food has such heavy weights, and those days, America just started using corn for oil. And we said, look, if this is how they distort the price, are we going to react to it? And OPEC has always played havoc from 73 onwards, we all know. And they've done it recently by cutting down on the barrels. So fuel was about 10%. We used to think with 60% of the weightage not in the hands of India, are we going to target a CPI with 40% and achieve success for the 100%? So you're right. But now, of late, my thoughts are, especially after COVID, and this book is placed after COVID, don't you think with the turn of things that has happened, maybe, as Dr. Virmani, Bhalla, and Basin say, that we have held back the critical poverty ratio because we have done the food distribution through the free price shops or through the fair price shops. I think the weightage of food as it stands now is pretty okay. And I'll tell you the reason. The fair price shops are only going to give me rice and wheat and some lentils, not all. But my food habits have moved from normal rice wheat subsistence, just holding on to my breath, to far more richer, protein rich diets. Something which Gokran also spoke about, but all the more now more relevant with unemployment rising, income levels depleting. Obviously, for a very large chunk of the society, food will play a prominent role. And my last question, Professor, now that you've written such an extensive book, looking forward, the Prime Minister has been talking about India at 100, India 2047. If we have to ask you as a listener, what are the three major things you would recommend that we continue our journey of overtaking countries? We have just overtaken UK. We continue our journey of overtaking countries and going and standing at number 3 after America and China in the next 25 years. What are the three major things that you would recommend? Thank you.
Thank you.
Thank you.
There's something wrong with my mute unmute button. Anyway, so Professor Morris, if you want to react to any of the things which I or Dr. Charan Singh has said, please do so. Then maybe we'll have time for a few more questions.
Yeah. Okay. So the
But
first
feel free to respond to anything you feel like.
Yeah. So, Dr. Virmani, the point that you brought out on the infrastructure lending and so on, and the mishap there, I think is extraordinarily important. And I didn't mention that for only the reason that I thought it was well known, but I think I should have still mentioned it, at least in the presentation. And there is a fair amount of coverage there, and I had written a paper there on, the mess up on infrastructure funding and financing. So essentially what has been happening is the following. India in the 12th plan at that time when the growth was being envisaged, thought that we would continue to grow at 9%, and we laid out a plan for PPPs, that means private investment through contractual arrangements, which if it had actually materialized would have been larger than the entire PPPs of the rest of the world put together. However, that didn't happen. The growth did not happen at 9 plus. It was obviously slowed down. But even then, the PPPs that happen in India continue to be large. So in some ways it's a credit, but in some ways also it was a huge problem because many of these PPPs were not, in my view, right structured. There was a great deal of improvement which could have been done, particularly the cost of interest rate risk, that means the interest rate changing risk, should have been internalized in the very design. In the RFP should have insisted RFP should have insisted on their internalization. Now, I say this with some confidence because actually infrastructure is my main area of work, including PPPs and so on. Okay, so this should have happened, but it didn't, and many other things should have happened. So many of the private investments were taking place in infrastructure with a certain, you know, ill intent. Let me put it that if, let us say, the downside happens, then I will always be able to pass it on either to the government or to the public sector banks. Remember, the public sector banks not having been not not having had the autonomy, they are the biggest, to use a colloquial term, bakras in this world, in India. All the negatives can be shifted onto them, and this is what many of the corporates which failed on infrastructure and on certain energy and such other projects did. And this brought about a huge constraint on the liquidity in uh, the actual credit available to even MSMEs in this MSMEs and other corporates in this period. And that was certainly important. What I have argued is this is known, so I'm going to argue that, but at the same time, I'll argue that the growth slowing down itself made many of the lendings by the banks, even private sector banks, go NPA, because when there is a slowdown, we know that NPAs are anti-cyclical. They rise when there is a when the GDP growth rate falls. So I would say this is important, and it's also important for another reason. By somewhere in the middle, by around 2016-17, the PSU, certainly by 18, the PSU bank should have been, their equity should have been shored up by the government. But they delayed that, and that created some problems. Okay, and that was only addressed during the COVID crisis by the generalized expansion of liquidity. So this is my understanding of that particular episode. But you're absolutely right that that's a big part of the story.
Right. Okay. Thank you. Thank you for clarifying that.
Yeah.
You have the analysis much better. I have a better sense of the inside story. And even though I had left the government in 2010, in Washington, I was hearing stories about phone banking coming from the finance ministry, where I had worked till 2009. Anyway, please go on.
Yeah. So that is the main thing. Now, yeah. So now coming to the issue of, which were raised by Dr. Charan Singh, what would be the right approach? Do you target nominal GDP, or what is it that you would target? I think the point is that we have so far had only two words, supply side inflation and a demand side inflation. Okay? A demand side inflation is when it works through the demand, and the supply side is when the expectations rise, not in sympathy with the demand side inflation, which is the first cause, which is the final, which is what is really at the back of it, but on its own. That means the exogenous rise in the expectations is what one would call a supply side inflation. Okay? However, I think macroeconomic policy now needs to go beyond the limited set of variables and look at the details of the supply side inflation, for instance. And when it does that, okay, there are two kinds of supply side inflations which are possible. One is when there is a constriction in the capacity itself. Okay. And the other is when there is a imported or a price rise because of high, price rises in commodities. Largely they can be imported or they can be on account of agriculture, because small imbalances in demand in both can raise the prices here very high, because the price elasticity of demand is such, being low, the small shortages can raise the demand. Okay, so when we now let's come to the India. So what I'm saying is that there are two types of supply side inflation, and if macroeconomic policy can recognize this, then the practice would be very interesting, and particularly after COVID, I think it becomes very important. See, the inflation that we are seeing today is essentially a logistic inflation, as I've called it. Now, what's a logistic inflation? that given the vast disruption and the slowdown or the shutting of plants which took place all over the world, when suddenly they come back or when they are allowed to come back, okay, there is no pathway which can take, let us say, ports to optimality. So imagine, say, Shanghai port completely shut down, having a traffic of 10%. Now it has to come back to its 100% level. Now, how does it prioritize? There are no models. Okay, because all models of port optimization are of port optimization, not of ports optimization. Okay, so there has to be time spent in each port doing things based on its own port optimization model, which then conflicts with when other ports do it. And slowly, what had evolved over a period of, let's say, 30 years would have to be done now over a period of a year or so, okay, maybe even more. So the point I'm trying to make is that logistic inflation is a very interesting kind of inflation which has happened and which is new for the world as a whole. Now, that has been an important contributor to inflation all over the world. And for India, that is, I think, the most important contribution. Okay? Uh, for the US, we all know that besides the logistic inflation, which would have hit them very hard because they were much more import dependent, right across the board, uh, and the demand side would also have contributed. So there is a mix of both out there, and the demand side inflation was clearly done by excessive, kind of fiscal stimulus through the transfer schemes and so on. Now, one may say that, well, this was instrumental. Okay, but my point is that you know inflation fighting may have to recognize and go below to what I would call semi-administrative measures. Okay, let's imagine the Russian oil crisis happening. Suppose, just for argument's sake, all US car owners had a ration card allocating them petrol, which was never operationalized except in an emergency. So in an emergency, the president declares that you had X liters of fuel allocated per car. Now it will be across the board cut in terms of 20%. Okay, but you're allowed tradability to prevent a market. Let's say you're allowed tradability. So if I still want to use the petrol, I'll have to go buy it at an inflated price from somebody else. Okay, so the price gets into a format by which customers benefit. Okay, because of the tradability, and the tradability is not allowed to be exercised by obviously corporates, okay, and suppliers. So what it does then is that the inflation is tolerable because everybody can move around. If I need to really move around, I will not sell my quota or that part of the quota, but I will do it. Now, this can be done for petroleum, it can't be done for food. Okay, but in food there is an automatic Maslow's need-based thing. So in India, we are in a right position to introduce a universal coverage through a card system which allows you to buy a certain quantity at a certain price. Okay, and that price can be fixed so that the market details of the studies can show this. Okay, and based on that they can do it. So if there is a universal, let us say, ration supply, ration provision, which can be activated during such emergencies when there is a real food shortage, okay, then the inflation can be controlled and it need not be hurtful. Okay, because the inflation on non-food or non-wage goods is of no consequence. And if we once recognize that, this
Yeah.
whole
Oh,
demand-based inflation targeting, okay, of every kind of inflation, whether it's due to food, whether it is due to wage goods, whether it is due to oil, and so on, can be controlled. That is because the central bank has no other instrument, and governments are not seeing these what one would say non-traditional instruments, okay, which are actually available, which have been ruled out on doctrinaire considerations. Okay, so that is what I would think the world needs to look at. Okay, but coming to a more looking at it more analytically. Okay, see, the point is that if you look at the now advanced or the now progress, the East Asian economies, the tiger economies, they always tolerated a certain degree of food inflation. Okay, there was no problem with that. Okay, and they may do that because they knew that people were not being hurt. Okay, and they never hit the demand in order to kill. So the point is the employment growth rate was a very important thing. Export growth rate was very important. The current account surpluses or non-deficits were important for that. So there is a huge lesson to be learned from there in terms of their macroeconomic policy. So, we get lost when we approach it from a doctrinaire standpoint, because then you say, hey, there is fiscal dominance. Okay. Now, my point is, what is this fiscal dominance? Okay. So fiscal dominance can easily come from
Professor, thank you. We have to move on. We've already overshot the time. I don't know.
Yeah. Right.
Sharon, is there any other question? Because we are running out of. We're already at 15 minutes over.
Okay, sure.
Somebody here.
Yeah.
Sorry, did you miss some other points?
No, I'm okay. I can come back to them if there is time. Yeah.
No, inflation target. You have to be a bit brief now.
Yeah.
You addressed this question of expectations, anchoring expectations. Is there any other issue?
Yeah. So the CPI, let me pick up the CPI point. Okay, because I think that can be dealt with briefly. Yes, I think the CPI in India is wrong for the reason that it is based on the NSSO. Now, the NSSO is a wonderful document in terms of the consumption expenditures which are person weighted. Okay, but given the extreme income inequality, the NSSO is not the right data for consumption weighted understanding of consumption. Okay, and when we target, and for macroeconomics, the consumption weight is important. What I mean by that is, NSSO ignores or is not able to capture, and it should not, and it would not actually capture all the expenditures which are higher on the Maslowian hierarchy. Okay, so for instance, restaurants, hotels, manufactured goods, which cater to the, let's say, cars and so on, it's heavily underrepresented. So hence the weight of food is very large. See, there is an obvious contradiction. The weight of food is only about 20% or less when we look at it from GDP point of view. But in CPI, it is about 34 now, and earlier it used to be 45. So that's clearly wrong, because if you want a consumption weighted CPI, then the NSSO is not the basis. Okay, so whereas the NSSO is the basis when I want to do poverty studies and so on. So this needs to be recognized, and unfortunately, macroeconomic RBI doesn't recognize this, because elsewhere this problem is not so high, because in fact there is no such NSSO. Okay? They do it in a very different way. Yeah. So now the expectations. See, expectations I have looked at, and what I would think is that in the Indian case, the expectations build up has never been the problem, because anytime the commodity inflation went down, the core also went down following that. Okay, so I can't see an overall trend irrespective of the explanatory core, commodity inflation. Okay.
So, yeah, I think Mr. Rajiv Dayanandan has been raising his hand, though I don't see it very clearly. Mr. Dayanandan, you want to ask question? Can't hear you.
I was just listening you sir.
Yeah, okay.
I was
Dr.
just
Kurian?
listening. Just listening.
Dr. Kurian, who was it? Yeah, Dr. Kurian?
Yes. At the outset, I want to thank the organizers as well as Professor Sebastian for giving this wonderful opportunity. I know the limitation of time, therefore I want to raise.
Brief, yeah.
I want to raise only two queries. One is in the initial years of our independence, especially Dr. K. N. Raj and the eminent economists of those times, they underlined inclusive growth. Inclusive growth as the most important objective of working of Indian economy. But we have the latest global hunger index. So from that point of view, where are we now? That is question number one. Question number two, I could hear a lot about the employment question, but what about the structural shift in the whole macro employment of India? Especially we find that growing migration of workers from north to south. I am from Kerala. I know how the northern workers are coming to Kerala, a small state. So what will be the macroeconomic implication of this sort of a labor market crisis? How we are going to address? So these are my
Okay,
queries.
yeah,
Thank you
thank
very
you.
much.
Is there any other questions? This is going to be the last answer. Charan, is there any other question? We'll take it together and then have Professor answer and conclude.
I think we will take this as the last.
Okay, so
Yeah.
Professor Morris, whatever you want to say, please try to be brief.
Yeah, sure. Yeah. Okay, so the first question, inclusive growth. See, the point is, I would believe that the later a country industrializes, or let us say starts that whole engine of growth, okay, the faster it grows. So if you look back and take all successful countries which have made their transition, that means they have burst through the middle income barrier and have gone on to become advanced countries. And there have been very few in the since the 20th century, the East Asian economies and so on. They all show one characteristic, that is they are necessarily inclusive. Without being inclusive, it doesn't mean that if you attempt to be inclusive and are ham-handed about macro policies, industrial policies and so on, you will have high growth. You may have only a migration or a migration based, remittance based economy, like Philippines. Okay, so Philippines did human capital and so on well, but it did not have a good engine of growth. Okay, so the Indian growth is floundering largely on the point that it's not as inclusive as it should have been. Had it been export-led growth, it would have been hugely inclusive. Had it been manufacturing-led, it would have been hugely inclusive. Okay. The other element is agriculture is not dynamic enough to be inclusive. Even today, wage consumption is not good enough, and there is still potential for wage consumption. Okay. So the point I would say is, yes, inclusion has to be the central thing, but in a way that this whole dichotomy between growth and development is a false one. Okay, completely false, and unfortunately NGOs have propagated that, many economists have picked it up and so on. Okay, now coming to structural shift in employment and so on. Okay, my argument or my point there is simple. Today, given technologies which are there on the shelf, we can, private capital, when it is there, will look forward to a labor productivity gain of around 4 to 5%. That means any growth under 5% is not going to result in labor absorption. So it means that you have to hit high growth, and high growth is going to be the most sustainable strategy for inclusion. Okay. Of course, high growth doesn't mean, let us say being pro business, creating rents for businesses and so on. It means actually putting money on the table, which private capital can pick up only by working very, very hard and being competitive. Okay. Creating the right kind of policy. So I would think the whole thing is not contradictory. I can approach the same problem from inclusion and employment, okay, and come to very much the same conclusion that we should be thinking of high growth. And unfortunately, what has happened today is that India's growth is high, but it's not high from India's standpoint. Okay? Because India is at a stage which is like China was in the 80s and 90s. It should be racing at 10%. Okay. So I'll stop there.
Thank you. That's a perfect note to end on. I'm sorry, I had asked you, Mr. Okay, I don't know. Again, you're raising your hand, Mr. Dayanandan, but anyway. Yes, I think that's a perfect note to end on because I'm in complete agreement with that. I guess after hearing you, I haven't read your book, but I think the conclusions we reach are broadly similar, though we may come from different paths. So I guess that's a good, happy note to end on. Thank you very much, Professor, and all the participants. And with that, let me pass it over to Charan to conclude the meeting.
So once again, I want to thank Professor for such an elegant discussion on your book. Your own presentation was so good. And I must thank the chairman for spending time with us today. And we have the benefit, he was in the thick of things after the financial crisis, the global financial crisis, and you started your book almost from there and discussed in detail. So thank you very much. This was great listening to both of you. I have a great news, and next week we have Dr. Prakash Kannan. He was a friend of mine. He was doing his PhD at Stanford, and I was doing my postdoc. He's the MD and chief economist at GIC Singapore. And he's going to be talking about the shape of the next cycle. So you can imagine how fascinating that talk is going to be. So I would invite all of you to please spare an hour and be with us next Friday. With that, let me thank each one of you, the participants, the speakers, the chairman, for this amazing session. It was excellent to have you, Professor Morris, with us, and we hope you will join us in future too, as a participant in enriching our discussions. Thank you very much.
Thank you. Thanks.